In the shadowed corridors of global finance, something unprecedented may be unfolding. According to a growing chorus of commodity analysts, Russia has allegedly executed one of the most audacious resource plays of the decade: the quiet removal of approximately 5,000 tons of physical silver from global markets. While mainstream media focuses on tanks and sanctions, some experts believe the real battlefield has shifted to commodity markets and supply chains. Silver, often dismissed as gold's lesser cousin, may be emerging as an unexpected weapon in the contest between competing geopolitical blocs. This is not about investment advice. This is an analysis of power, leverage, and the weaponization of scarcity in an increasingly fragmented world order. Reports from commodity research firms suggest that Russian entities have been systematically acquiring physical silver over recent years. Unlike gold purchases, which Russia's central bank documented publicly, silver acquisition appears to have occurred through opaque channels: industrial buyers, strategic reserves, and transactions through intermediary jurisdictions. The alleged scale is staggering. 5,000 tons represents approximately 160 million troy ounces, roughly 18% of annual global mine supply. To contextualize, the entire COMEX registered silver inventory typically hovers around 50–80 million ounces. If accurate, Russia's rumored stockpile would dwarf America's primary precious metals exchange inventory. What makes this particularly noteworthy is the strategic pivot it represents. Russia accumulated over 2,300 tons of gold before Western sanctions complicated further purchases. According to analysts, the shift towards silver reflects industrial leverage rather than purely monetary reserves. Several indicators support the accumulation thesis. Russian domestic silver production has increasingly disappeared from Western export channels. Simultaneously, imports from Kazakhstan and other CIS partners have reportedly increased while exports to Europe declined precipitously. The timing coincides with intensification of Western sanctions after 2022. Having experienced the freezing of approximately $300 billion in foreign reserves, Russian strategists learned a stark lesson. Digital assets can be neutralized instantly. Physical commodities within your borders remain under sovereign control regardless of external political pressure. To understand why silver matters in modern conflict, we must recognize it's not just a monetary metal. Silver is the most electrically conductive, thermally conductive, and reflective element available at industrial scale. Advanced weapon systems depend critically on silver. Every Tomahawk cruise missile requires approximately 500 ounces in guidance systems and electronics. F-35 fighter jets use silver in radar systems and engine components. Military satellites may contain several hundred pounds of silver in solar panels, thermal systems, and circuitry. Unlike many materials where substitutes exist, silver's unique properties make it irreplaceable in mission-critical applications. Aerospace engineers have investigated alternatives for decades. None match silver's performance in high-stakes environments where failure is unacceptable. Beyond defense, silver is essential to semiconductors, 5G infrastructure, medical devices, and renewable energy. Each gigawatt of solar capacity requires 10 to 12 tons of silver. As Western nations pursue aggressive decarbonization, silver demand is projected to surge. This creates strategic asymmetry. Nations controlling significant silver reserves gain leverage over adversaries dependent on continued access. If Western defense contractors or semiconductor manufacturers face supply constraints, production timelines extend, weapons programs face delays, and economic competitiveness erodes. Some analysts argue this represents asymmetric warfare perfectly calibrated for the modern era, operating below the threshold of direct military confrontation while imposing cumulative strategic costs. Rather than launching missiles, you create bottlenecks in your opponent's industrial ecosystem. Western financial sanctions depend on controlling digital infrastructure, freezing assets, denying banking access, restricting capital flows. These proved devastatingly effective during unchallenged dollar hegemony. Physical commodities exist outside this paradigm. You cannot freeze silver bars in Russian warehouses the way you freeze digital euros in Frankfurt banks. You cannot sanction chemical properties or prevent domestic manufacturing use. Russia has systematically reoriented its economic relationships since 2014, accelerating after 2022. Trade with China increasingly uses non-dollar settlement. The country's established ruble-yuan swap lines and payment channels bypassing SWIFT. India continues purchasing Russian energy through rupee-ruble arrangements despite Western pressure. The BRICS expansion, adding Saudi Arabia, UAE, Egypt, Ethiopia, and Iran, further dilutes Western sanctioning power. These nations represent critical nodes in global commodity flows and trade routes. If this bloc develops robust, non-dollar infrastructure backed by physical commodities, Western financial pressure diminishes proportionally. Silver accumulation fits elegantly within this reorientation. Unlike reserve currencies deriving value from institutional trust, commodity money derives value from physical utility and scarcity. Physical commodities enable barter-style arrangements circumventing the dollar system entirely. Russia provides energy to China. China provides manufactured goods. Both settle in physical commodities or bilateral currencies. Each such transaction chips away at dollar dominance architecture. From this perspective, silver accumulation represents a vote of no confidence in the existing international financial system, a strategic judgment that the future economy will be more fragmented and more dependent on tangible assets than digital accounting entries. While Russian accumulation remains partially obscured, alleged effects are visible in Western markets. COMEX silver inventories have exhibited unusual volatility, with registered stocks declining to levels not seen in over a decade. At times, holdings have fallen below 40 million ounces even as futures contract open interest remained elevated. This creates mathematical tension. The silver futures market operates on fractional reserve principles. Paper contracts vastly exceed physical metal available for delivery. Under normal circumstances, this works because most contracts are cash settled. The system functions when participants trust that physical delivery remains possible. However, if significant global supply has been removed from Western markets and demand for actual delivery increases, the architecture becomes unstable. Analysts point to elevated premiums for physical silver over spot prices, lengthening delivery times, and increasing basis spreads between futures and physical markets. Particularly concerning are reports of difficulty sourcing large quantities for industrial consumers. While retail investors can still purchase coins, manufacturers requiring multi-ton quantities have encountered longer lead times and less favorable pricing. This suggests wholesale-level tightness not yet fully reflected in spot prices. The situation is complicated by substantial short positions maintained by major bullion banks in COMEX futures. According to CFTC data, commercial banks hold large short positions that generate profits if prices decline, but expose holders to unlimited losses if prices surge. If physical availability is constrained and industrial demand increases, banks maintaining these positions face a classic squeeze. They must deliver metal they cannot source or buy back shorts at escalating prices. The ultimate question is confidence. If market participants doubt whether the system can actually deliver metal when called upon, the resulting repricing could be abrupt and severe. Europe finds itself particularly exposed. The continent produces less than 10% of its industrial silver consumption, making it heavily dependent on imports precisely as EU climate commitments require massive deployment of silver-intensive technologies. The European Green Deal targets hundreds of gigawatts of new solar capacity by 2030. Simple arithmetic reveals the challenge. Achieving these targets requires thousands of tons of additional silver as global markets potentially tighten. Electric vehicle production presents similar dependencies. Modern EVs contain 25 to 50 grams of silver per vehicle in electrical contacts and battery systems. As European automakers transition toward electrification, silver consumption could double or triple by 2030. Electronics and semiconductor sectors add further pressure. European efforts to rebuild domestic chip manufacturing require silver for fabrication processes and specialized components. When ambitious policy goals collide with supply reality, several scenarios emerge. First, costs increase as manufacturers compete for limited supply, feeding inflation through to consumers. Second, production timelines extend as companies wait for material availability. Third, Manufacturers seek inferior substitutes that compromise performance. Most concerning is the strategic dependency this creates. If European industry requires continuous silver imports, and those imports must be sourced from regions aligned with geopolitical competitors, leverage shifts dramatically. Russia and China collectively influence significant portions of global silver supply through production, refining, and relationships with Latin American mining regions. The 2022 Russian gas crisis provided a preview of Europe's vulnerability to commodity dependencies. Silver presents a different challenge. There are no quick substitutes, and developing new mines requires 5 to 10 years. The supply response cannot materialize rapidly enough to address acute shortages. Russian silver accumulation must be understood within broader changes in global monetary relationships. For 7 decades, the US dollar functioned as the world's primary reserve currency, enabling America to run persistent deficits and project economic power through financial infrastructure control. That system faces unprecedented stress. According to IMF data, the dollar's share of global central bank reserves has declined from approximately 72% in 2000 to roughly 59% recently, the lowest since the mid-1990s. Aggressive financial sanctions demonstrated that holding reserves in dollars or euros carries political risk. The freezing of Russian reserves crystallized concerns resonating far beyond Moscow. Countries from India to Saudi Arabia question whether concentrating reserves in Western currencies serves their security interests. Simultaneously, chronic Western inflation has undermined purchasing power preservation. Central banks watched their dollar and euro holdings erode in real terms as inflation exceeded yields on government bonds. Physical commodities have generally maintained or increased purchasing power during inflationary periods. Into this environment comes discussion of alternative monetary frameworks. BRICS nations have explored concepts for commodity-backed currencies or settlement units. Baskets of commodities including gold, silver, oil, and strategic materials providing intrinsic value divorced from any single nation's policies. Silver features prominently because of its dual monetary industrial nature. Unlike gold, which primarily stores value, silver combines monetary properties with industrial indispensability. A settlement system backed partially by silver draws value from both traditional monetary roles and assured industrial demand. Whether such systems materialize remains uncertain, but the discussion reflects changing assumptions. Nations are reassessing what gives money value, what institutions can be trusted, what forms of wealth remain secure during geopolitical fragmentation. China's Belt and Road Initiative, gold accumulation, and mining investments across Latin America and Africa suggest long-term positioning at commodity flow centers in a potentially post-dollar world. Russia's alleged silver accumulation may represent parallel strategy, building leverage through control of materials essential to modern civilization while hedging against fiat currency vulnerabilities. An underappreciated dimension concerns modern financial systems' vulnerability to cyber attacks and technological failures. The global financial system operates almost entirely through digital networks, electronic ledgers, and interconnected databases, tracking ownership and settling accounts. This efficiency creates systemic fragility. Security researchers extensively document critical financial infrastructure vulnerability to sophisticated cyber attacks. Well-coordinated assaults on banking networks or exchange infrastructure could disrupt the ability to verify ownership, execute transactions, or access digitally stored wealth. Consider implications during heightened tensions. If adversarial nations disrupt Western financial networks, wealth stored purely digitally becomes inaccessible or lost. Physical assets remain tangible and controllable regardless of network status. A central bank's gold and silver in secure vaults remain accessible even if every computer network goes dark. Digital currencies or bond holdings become inaccessible if systems tracking ownership fail. From a national security perspective, this distinction matters enormously. The issue extends beyond deliberate attacks to systemic technological failures. Modern financial systems have experienced repeated flash crashes and algorithmic malfunctions. Physical commodities provide hedges against such scenarios, anchors of value existing independent of technological systems. Some defense analysts argue economic warfare will increasingly be fought through cyber means. If correct, nations holding significant physical reserves gain strategic advantages. They can sustain economic functions and preserve wealth when digital networks are compromised. For American citizens, these developments connect directly to manufacturing competitiveness, defense capabilities, inflation, and economic security. The United States imports approximately 70% of consumed silver annually. Domestic mining has declined while industrial consumption increased, making manufacturers dependent on global supply chains for material essential to defense production, high-technology manufacturing, and infrastructure. The Department of Defense designates silver as strategically critical. Every major weapon system requires silver. If global supply tightens and prices surge, defense procurement costs increase substantially, forcing difficult choices in constrained budgets. The civilian economy faces parallel challenges. Semiconductor manufacturers require reliable silver access. Solar deployment depends on economically viable silver prices. Medical device manufacturers use silver in antimicrobial applications. Each sector faces potential disruption from severe market dislocations. Inflation represents the most immediate consumer concern. If silver prices spike, costs propagate through supply chains to consumers. Electronics become more expensive. Solar installations cost more. Vehicle prices increase. The cumulative effect erodes purchasing power. Retirement security could be affected. Pension funds and retirement accounts heavily invested in dollar-denominated financial assets depend on the dollar maintaining purchasing power and the financial system functioning smoothly. If confidence erodes, real value of retirement savings declines. The broader implication concerns American competitiveness in strategic industries. If the U.S. cannot secure reliable critical material, supplies at competitive prices, manufacturing migrates to regions that can. Industrial capacity, technological expertise, and high-wage employment follow. Some economists argue market mechanisms will resolve imbalances. Higher prices incentivize production, substitution, and efficiency. This works eventually, but the transition can be economically painful. Mines take years to develop. During adjustment periods, supply remains tight and prices elevated. Several potential trajectories emerge depending on how governments, markets, and geopolitical tensions evolve. The first scenario involves market rebalancing without severe disruption. Higher prices incentivize mining production, recycling intensifies, manufacturers develop substitutes, and demand moderates. Supply adjusts to meet requirements at elevated prices. This represents the optimistic case. However, analysts increasingly consider this unlikely given time required for new supply and industrial demand trajectory. Major mining projects require 5 to 10 years. Existing mines face declining ore grades and rising costs. Meanwhile, electrification and renewable mandates ensure continued demand growth. A second scenario involves persistent constraints leading to price shocks and industrial disruptions. Western manufacturers face recurring shortages, production delays become common, and inflation proves stubborn. Defense programs face budget overruns. The green transition slows. Economic growth weakens as bottlenecks constrain output. This might prompt belated responses, reestablishing strategic reserves, incentivizing domestic mining, funding substitution research, negotiating supply agreements. However, these measures take years to yield results. A third scenario involves cascading failures in paper precious metals markets. If physical delivery demands exceed available supply, exchanges or banks could face defaults where they cannot fulfill obligations. This might trigger broader commodity market crisis, disrupting hedging mechanisms. Price discovery would shift to opaque physical markets, introducing volatility. Geopolitical escalation represents a fourth trajectory. If commodity accumulation is deliberate economic warfare, adversaries might intensify strategy across multiple materials. Economic blocs could formalize with BRICS and Western allies operating increasingly separate markets. In extreme cases, fragmentation could lead to export controls exacerbating shortages. Meaningful responses require long-term strategic planning, securing supply chains through diplomatic relationships, rebuilding domestic capacity, maintaining strategic reserves, and funding substitution technologies. However, such efforts require sustained political will and substantial investment competing with numerous other priorities. For individuals seeking to understand these developments, several principles deserve consideration while avoiding panic or precipitous decisions. First, recognize that commodity markets and geopolitical strategies operate on time frames measured in years and decades. Even significant supply disruptions take time to fully manifest. Historical precedent suggests gradual adjustments rather than immediate catastrophe. Second, understand these dynamics affect different groups differently. Industrial manufacturers face operational challenges. Investors holding potentially weakening currencies face purchasing power risks. Consumers face indirect effects through inflation. Specific implications depend on individual circumstances. Third, historical patterns reveal retail awareness typically lags institutional recognition by months or years. When major funds, central banks, and corporations accumulate physical assets, their actions gradually affect markets. Public awareness usually emerges only after significant price movements, at which point risk-reward profiles have shifted. This pattern has repeated across crises. Institutional investors recognized housing vulnerabilities years before 2008 became apparent publicly. Sovereign wealth funds accumulated gold throughout the 2000s, while mainstream attention remained elsewhere. The informed-uninformed gap creates asymmetries. Fourth, distinguishing signal from noise requires critical evaluation of sources. The precious metals sector attracts both legitimate analysis and sensationalist promotion. Reliable analysis includes specific data citations, acknowledges uncertainties, presents alternative scenarios, and avoids absolute predictions. Fifth, recognize personal financial decisions should never be based solely on geopolitical speculation, regardless of how compelling the narrative. Individual circumstances, income stability, debt levels, time horizon, risk tolerance, dwarf macroeconomic considerations. What informed awareness enables is asking better questions and monitoring relevant indicators. Are industrial metals experiencing supply tightness? Are geopolitical tensions affecting commodity flows? Are central banks diversifying reserves? Are policymakers addressing strategic vulnerabilities? Additionally, understanding these dynamics informs civic participation. Voters can ask whether candidates address supply chain vulnerabilities. Citizens can evaluate whether industrial policy considers critical material dependencies. These broader questions affect collective welfare. Perhaps most importantly, maintaining perspective about what we can and cannot know remains crucial. Russian silver accumulation is based on trade flow analysis and strategic logic, not official confirmation. It represents informed speculation, not established fact. Uncertainty pervades these assessments. The future remains contingent on innumerable variables, policy decisions not yet made, technological developments not yet achieved, events not yet occurred. Preparing for multiple possible futures proves more prudent than betting on a single predicted outcome. We find ourselves at a peculiar moment where the fundamental architecture of global finance faces questions not seriously entertained since the immediate post-World War II period. The Bretton Woods system that established dollar dominance assumed conditions that no longer fully obtain. Whether Russia has actually accumulated 5,000 tons of silver remains unproven in a strict evidentiary sense. What we observe with greater confidence are structural tensions making such a strategy plausible and potentially effective. Tightening physical markets, increasing industrial demand, geopolitical fragmentation, erosion of dollar-centric architecture, and Western vulnerability to strategic material constraints. The question is not whether you should immediately restructure your financial life. The question is whether these patterns, if they continue, represent early indicators of broader reorganization of how power, wealth, and resources flow through the global system. Commodities have been instruments of geopolitical leverage throughout history. Britain's dominance rested partly on coal and iron. Oil shaped 20th century competition. Perhaps silver and strategic materials essential to high technology civilization represent the next iteration, resources whose control confers advantages transcending mere economic value. The comfortable assumptions of the globalization era that markets remain open, cooperation prevails, economic interdependence prevents conflict require re-examination in light of current evidence. What happens next depends on choices not yet made and events not yet unfolded. Whether this represents temporary market distortion or fundamental reorganization remains genuinely uncertain. What seems clear is that the status quo faces challenges from multiple directions, and the resolution will determine the shape of the global economy for the generation ahead.